Well, markets are priced to expect that the Fed will cut rates to save growth. My feeling is the bigger risk is that the Fed will have to actually hike rates to save the bond market. Let me explain. If the Fed cuts rates because growth is cooling, that's already in the price. I don't expect much of a market reaction in that scenario. If the Fed does not cut rates because growth has been solid, that's also a good outcome. That means we have economic resilience. But if the Fed has to hike rates, what it means is there was political pressure to cut rates prematurely, and that would accelerate inflation. The Fed would then have to play catch up to stabilize the bond market. That's what worries me. Well, the Fed independence is the anchor of global financial stability. If the anchor is adrift, that means every asset that produces cash flow will have a higher risk premium. That's a bad outcome. And so yes, I'm worried about that scenario because we're going to have personnel changes at the leadership of the Fed, but you also have to remember, the Fed is not constitutionally independent. It answers to Congress, and Congress, with a simple majority, can amend the Federal Reserve Act. It's been amended over 200 times, and Treasury Secretary Bessent has already talked about potentially subordinating monetary policy to political authorities. That would be a big concern for the market. The October truce, think of it as a painkiller, not a cure. Okay, we're not going back to the baseline of 2016. We may be going back to a much older normal. If you look at what the US average tariff rate is right now, it's the highest since 1934. And so we're in a world in which we're going to have higher barriers, higher frictions, smaller markets, less efficiency, higher trend inflation, and also, sadly, more geopolitical friction. Well, look, if I'm looking at why yields move, not what they do. So if yields rise because growth is better, no problem. If yields rise, if borrowing costs rise because inflation is higher or deficit concerns have grown, that's a problem. That means we're probably going to have a correction in stock markets as well. The other signal I would watch for is Japan. It's the third largest bond market in the world. Right now, they're practicing much looser fiscal policy. They may have to tighten monetary policy to stabilize the bond market. If they don't, there'll be global ripple effects.
Is it a bubble?
It's both a bubble and a bust. What I mean is, this is the biggest CapEx boom since the railroads. And in every other CapEx boom like this one, you have had certain business models that go bust, but what it leaves in its wake is a productivity and growth tailwind. I expect the same to play out this time.